Hey everyone, welcome back to Corporate Decoder, the place where we unpack the hidden stories in corporate filings, and I've got a doozy for you today. We're diving into Veritone's latest financial report, and let's just say they've been through a bit of a roller coaster. This report paints a picture of a company navigating some serious financial waters, from significant debt to trying to find its footing after selling off parts of its business. It is a tale of shifting strategies and the constant pressure to innovate, especially in the fast-paced world of artificial intelligence. Can they pull it off? Let's find out before we jump in. If you love getting the real scoop behind the corporate jargon, make sure you are subscribed. And hey, join our Discord community, link down below for more exclusive insights and discussions. So, we are looking at Veritone Incorporated's quarterly report for the period ending the 30th of September 2025. This is essentially their progress report card for the last 3 months. Let's start by looking at the company's financial snapshot. Its balance sheet. Think of this as a snapshot of everything the company owns and everything it owes at a specific moment. As of the 30th of September 2025, Veritone had about $35 million in accounts receivable net. This means money that customers owe them for goods or services already delivered. That is up a bit from the end of 2024. They also have $13.3 million in prepaid expenses and other current assets. This includes things they've paid for in advance, like insurance or rent, and some other short-term assets. It is good to see this has grown, suggesting some smart pre-planning. Overall, their total assets stand at just over $200 million. This includes everything from cash to their property and equipment, and even things like goodwill, which represents the value of their brand and customer relationships beyond their tangible assets. Now, let's talk about what they owe. They had about $11.5 million in accounts payable, which is money owed to their suppliers. This is pretty stable. They also have $12.4 million in deferred revenue. This is money they've received from customers for services not yet rendered. It is essentially unearned revenue, and it is good that this has increased, as it means people are paying in advance for their future services. And then there is their debt. They have a term loan with about $7.75 million due within the next year. Debt is always something to watch. In total, their total liabilities are over $184 million. This is a significant amount and needs careful management. Looking at the equity side, common stock has seen a big jump in issued and outstanding shares, going from about 40,000 to over 70,000. This indicates they've been issuing a lot of new stock. This is reflected in their additional paid in capital, which has also significantly increased, jumping from around $480 million to over $557 million. This large increase is a direct result of those new shares being issued. However, they still have a large accumulated deficit of over $540 million. This means that over their history, the company has lost more money than it has made. This is common for growing tech companies, but it is a number that investors always watch closely. Despite the deficit, their total stockholders' equity is positive, standing at $16 million. This is a good sign, meaning the company's assets are worth more than its liabilities, even with that historical deficit. Now, let's look at how they performed financially over the last few months, specifically through their statements of operations, which shows their earnings and losses. For the 3 months ending the 30th of September 2025, revenue was about $29.1 million. That is a solid increase compared to $22 million in the same period last year. For the first 9 months of the year, revenue hit $75.6 million, up from $70.2 million last year. So, the top line is growing. Their cost of revenue, the direct costs of providing their services, also rose. For the quarter, it was $8.6 million, up from $6.3 million last year. This means it costs them more to generate that higher revenue. Despite the revenue growth, the company reported an operating loss of $15.8 million for the quarter. This is better than the $22.5 million loss from last year's quarter, but still a significant loss. Over the 9 months, the operating loss was $56.7 million. When you factor in interest and other expenses, their loss from continuing operations before income taxes was $27.2 million for the quarter. That is a bit worse than the $25 million loss last year. And ultimately, they reported a net loss of $26.9 million for the quarter and a whopping $73.5 million loss for the 9 months. While revenue is up, they are still losing money. This translates to a loss per share of $0.41 for the quarter. This is a key number for investors as it shows how much each individual share is contributing to the company's losses. Something interesting here is the foreign currency translation adjustment. For the quarter, this was actually a positive $244,000, meaning changes in currency values helped their financials slightly, but over the 9 months it was a negative $836,000. Let us quickly glance at the statements of changes in stockholders' equity. This shows how the owner's stake in the company has changed. We see a lot of activity here. Common stock issued under employee stock plans and common stock and pre-funded warrants issued in connection with registered direct offering. This confirms our earlier suspicion that they've been issuing a lot of new shares. Stock-based compensation is treated as an expense, and it is a significant one. The net loss entries here directly reflect the bottom line losses we saw earlier from the income statement. Now, for the real meat and potatoes for many, the statements of cash flows. This tells us where the company's cash is coming from and going. Can they generate cash from their operations? Again, we see that net loss staring us in the face. For the 9 months, it is a big number, $73.5 million. But here is where it gets interesting. You see net cash used in operating activities from continuing operations. For the 9 months, this is a negative $41.2 million. This means even though their reported loss is higher, they're using less cash than that in their day operations. This is often due to non-cash expenses like depreciation and stock-based compensation being added back. In investing activities, they spent $3.5 million on capital expenditures, which are investments in things like equipment and technology. This is a normal part of running a business. The financing activities section is where the real action is. They have over $64 million in net cash provided by financing activities from continuing operations for the 9 months. This is mostly from issuing stock. That huge number, $70.9 million, comes from proceeds from issuance of stock and pre-funded warrants under registered direct offerings and at the market offering. This means they sold a lot of new stock to raise cash. That is how they're funding their operations and paying down debt. Let's touch on a couple of key policies. Companies have to make estimates and assumptions for many things, like how much their assets are worth or how much bad debt they'll have. These are subjective and can impact the financials. This next part is serious. The report mentions liquidity, capital resources, and going concern. What does going concern mean? It means, can the company continue to operate for the next year? The report states that management determined that there is substantial doubt about the company's ability to continue as a going concern. This is a red flag. It means that based on their current cash, losses, and debts, there is a real question about whether they can keep their doors open over the next 12 months without more funding. They are relying on raising more money or restructuring to survive. Veritone sold off its advertising agency, Veritone 1. This is called a divestiture. They've moved Veritone 1's past results into discontinued operations so they can focus on their core AI business. This debt section is crucial. They have a senior secured term loan and convertible senior notes. As of the 30th of September 2025, they had about $35 million outstanding on their term loan. But here is a big update for November 2025. They announced they intend to repay the entire term loan, about $36.7 million, which includes a prepayment premium. This will eliminate that obligation. They also have $91.3 million aggregate principal amount outstanding under our convertible notes. In a move to ease their debt burden, they've also announced a repurchase of about 50% of these notes, around $45.7 million, part cash and part stock. This is a significant step to manage their liabilities. Understanding loss per share is key. It tells you how much of the company's profit or loss is tied to each share. In this case, it is losses. They use fair value measurements to value certain assets and liabilities like that Veritone 1 earnout receivable, which is essentially a potential future payment they might receive from the sale of that business. The Veritone 1 earnout receivable started at $7.6 million at the end of 2024 and has dropped significantly to just $454,000 as of the 30th of September 2025. This means the expected future payout from that sale has diminished, likely because the business they sold isn't hitting its revenue targets. They have about $53 million in goodwill and over $42 million in intangible assets like technology and customer relationships. These are important, but they can also be subject to impairment if the underlying business doesn't perform. Looking at prepaid expenses and other current assets, we see that indemnification escrow holdback of $3.65 million is listed. This is money held back related to potential claims claims from past deals. Interestingly, they received this back in October 2025, according to the report. Let's dive back into the revenue streams. Veritone breaks down its revenue into software products and services and managed services. For the quarter, commercial enterprise software products and services revenue grew almost 60% to $20.8 million, largely thanks to their VDR product. This is a really positive sign, showing their core AI offerings are gaining traction. Public sector revenue also saw growth, up by about 24%. This sector is often project-based, so fluctuations are expected, but steady growth is good. However, managed services revenue, which includes things like representation services, decreased. This is likely due to the challenging macro environment mentioned earlier, affecting advertising and related services. The cost of revenue as a percentage of revenue increased slightly. This means it is costing them more to deliver their services, partly due to a higher mix of lower margin revenue like VDR. Sales and marketing expenses stayed relatively flat year over year, but as a percentage of revenue they decreased significantly. This suggests they're getting more bang for their buck in sales efforts, which is efficient. Impressively, research and development expenses decreased by about 19% for the quarter and a hefty 26% for the 9 months. This is a result of cost-cutting initiatives, but it could also mean slower innovation if not managed carefully. General and administrative expenses also saw a decrease, showing progress in streamlining operations. Despite these cost controls, the operating loss still stands. However, the expense reduction is a positive step. Interest expense net decreased slightly, which is good as they manage their debt. Other expense income net shows a significant shift. For the 2025 quarter, it is $8.5 million in expense, largely driven by that loss on revaluation of the Veritone 1 earnout receivable. This is why the earnout value dropped so much. It is important to remember the net income from discontinued operations. This is the profit Veritone 1 made before it was sold. It is shown separately because it is no longer part of the ongoing business. Now, let's talk about the big picture. Veritone is in a tough spot with that going concern statement. It is a serious warning sign that they need to secure more funding or achieve profitability very soon. They've been issuing a lot of stock, which dilutes existing shareholders but provides essential cash. The good news is that their core software products and services revenue is growing, especially in the commercial enterprise sector driven by products like VDR. This shows they have a valuable product in the AI space. Their disciplined cost cutting also shows a commitment to efficiency. However, the reliance on equity raises is a concern. It is like a company constantly needing to sell pieces of itself to stay afloat. They've taken smart steps to reduce debt by paying off the term loan and repurchasing convertible notes, which is a good move to de-risk the company. The decreased R&D spending is something to monitor. While cost control is vital, a company in the AI race needs continuous innovation. Overall, Veritone is in a turnaround phase. They are growing revenue in key areas and cleaning up their balance sheet by tackling debt. But the going concern warning means they are not out of the woods yet. Their ability to execute on their growth strategy, especially in the public sector and with VDR, will be critical. What is your take on Veritone's financial health and their aggressive strategy to raise cash and cut debt? Let me know in the comments below if you found this breakdown useful. Give this video a thumbs up and subscribe for more corporate deep dives. And don't forget to join our Discord community linked in the description for even more insights. Thanks for watching. See you next time.